Betty. I'm so happy that you have decided to continue on with me in this journey of financial accounting. This week we're going to talk about plant assets, natural resources, and intangibles. Again, this is all about our accounting of these particular assets and why it's so important to grasp them in their presentation on the financial statements. As always, when you're reading through the chapter, particularly when you're really going through and trying to understand the concepts, it's important to know why you're looking at the chapter and what are you to get out of that chapter. So we're going to explain how to account for these assets. We're going to distinguish between a capitalization of an asset, or in this case an expense, immediate expense. Capitalizing something is we're going to be spreading that cost over its life, over its useful life, because we're going to continue to use it over and over again. It's not used up immediately. We're going to explain how to account for depreciation. How do we depreciate? On what type of assets we're depreciating? Assets that have a physical form, plant assets in this case. We're going to talk about what happens when we dispose of an asset. We're going to talk about the rules that relate to intangible assets and natural resources. And we're going to talk about what happens when an asset is impaired. What really happens and how we're going to deal with that on our financial statements. We're going to talk about some ratios, again, return on our assets, and also the cash flow impact of long-lived assets and the transactions. So it's important to deal. What is a long-lived asset? What is it? We've got assets that live a long time, and I'm talking about more than one year. Our land is one. Buildings and machinery, computers. Even though it's not on this list, cars, office furniture, fixtures, that sort of thing. Everything that we can use that has a physical form, pretty much. Natural resources, obviously, is going to be like oil and petroleum and things of that sort, things you get from nature. And then intangible assets give you a lot of that. Examples, obviously, it's going to be goodwill, it's going to be franchise licensing and so forth. These are assets and they have value to you that you can use, but they have no physical substance, and we're going to amortize those. Reason why we deplete natural resources because they are used up. These are assets that are actually used up. And then assets that we actually use, the plant assets going to be depreciated. Knowing the differences among those three terms is not a big deal because they're really, in my opinion, intuitive. So, rule. Cost of an asset is going to be the sum of all the costs that bring that asset to its intended use. That means sales tax, that means purchase price, that means commissions, that means closing costs. Any cost that you have to incur in order to use it or to bring that asset to its use. It's going to be included in that, and that's very important. So it's not going to be just a purchase price, it's going to be other costs as well. So it's important for us to know that. Accounting is going to give us that information. We want to be able to put on our books the cost of that asset, and that cost of that asset is going to be the price of that asset and the taxes associated with that asset, commissions and other costs, legal costs, whatever costs associated, until that asset is actually put together and ready to be used. Costs associated that's going to be capitalized or become a part of that asset. So land is the same thing. Land has a different type of cost because generally when you buy land or any kind of property, you're going to have to go to an attorney. You're going to have to close, which pays recording fees and survey fees and commissions and real estate fees and all that sort of thing, in addition to the price of that land that you're purchasing. And if you have to remove unwanted buildings, that's going to be a part of that. You're going to have to preparing that land for its use, clearing it, and that sort of thing, property taxes. And it's important because if there's a question asked of you, what's the cost of this land, and you see all these other costs, you have to think, okay, I need to include them both in the acquisition cost of that asset. So in this case here, it says FedEx is going to sign a note. It's going to purchase 20 acres of land. It also pays $10,000 for real estate commission, $8,000 back property taxes, removal of the old building, survey fee, and $200,000 to pay the parking lot. What is the true cost of the land? And sometimes you'll see in here, it's going to always have a little trick, something that's in there that you don't necessarily need. And if you could think about it, the purchase of the land clearly is going to be a part of the cost. But you have to remember, it only includes costs that will bring that asset to its intended use. Does real estate bring it to its intended use? Yes, because in order for you to transfer the title, you have to buy it, and you pay for a real estate agent to do that. Number two, the top property tax. The title is not going to pass until the government gets its money. property tax. The removal of the building. Again, you have to remove the building in order for you to use it the way you intended. So you're going to have to pay for that, and it's going to be a part of the cost. Any survey fees. Again, all these costs associated with bringing this land to the point where this organization can use it. So the total cost of land is not only the price of the land, but also those other costs, the $324,000. But you'll notice also $260,000 was not included. Why? Because it does not bring that asset to its intended use. Now, it could very well be capitalized, but for the cost, it's asking you what is the cost of that asset, and that's it. So, again, we're going to continue on, and here is our entry. Again, the cost of the land and all of the costs associated with bringing that land to its intended use. The note and the difference is going to be assumed to be cash that you paid out. So, building, machinery, and equipment. And again, you're going to be asked questions. What is the total cost of these buildings, equipment, or so forth? How do we determine that? Well, we're going to construct a building. We're going to have to deal with the permits, contractors' fees, material, labor, and overhead. If you borrow money, you're going to have to take into consideration the interest on that, and annual architectural fees. Again, these are just many of examples, not all inclusive, but it gives you an idea that the cost of a building is not all that you need to consider when you record that asset on your books. That's essentially what we're trying to do here. The same is true for equipment. If you have to bring that, if you have to pay for insurance, if you have to install a certain thing or install it into your building or into your office, you have to pay. That has to be capitalized. Any commissions associated with it, any taxes, any transportation that you have to pay, or anything that you have to do to bring that equipment to a place where it can be used in your business, is going to be included in the cost, the initial cost of that asset. Now, landhold improvements. Remember in the last example, the previous example, we talked about the $260,000 that was paid for pavement. Well, we didn't put it in the cost of the land, but we can put it in as land improvements. You see, and it's important to see the difference in those terminology. So we didn't include the $260,000 in the price of the land. But we still going to have to deal with that $260,000 as an improvement to that land, and again a capitalized asset because it has a life that's longer than 1 year. And here we are, leasehold improvements. Again, all about how you are going to deal with the costs associated with a property that you are leasing. If these are substantial and a part of the lease, you have to pay it. It would be best to take that leasehold and spread it over the life of that lease. That's going to be the amortization, not over the life of the asset, but over the life of the lease itself. So, again, if you're going to buy purchases of assets in lump sum, again, you want to be able to take the total value of those assets and then a proportionate share of each piece of the asset of that total. And it's not a big deal. It's a very, very small, very, very easy to understand computation, as you can see here. Again, we have the market value. You paid $2.7 million, or you paid $2.8 million, but neither one of those assets have a specific price. You have to figure out, based on the allocation of that total, what portion of that asset cost should be allocated to each one of the assets. And here we are. Distinguish between a capital expenditure and a immediate expense. Okay, if a capital expenditure requirement means that you can extend the life of that asset or its capacity to be used. If you take and remove the roof of your building, that's extending the life and it needs to be capitalized. If it is like maintaining, meaning you're cleaning or you're maintaining that property, you're not going to capitalize it. That's going to be maintenance and repairs. That's going to be expensed immediately. The main criterion is, has the life of that asset been extended through that particular cost. And if it's going to extend the life, it's going to be capitalized and it's going to be a part of the asset. If it is not going to extend the life and it is repairing something or other maintenance type of costs, again, you're going to expense it. So here's some details. Ordinary repairs and expense, oil change, replacement of tires, that kind of thing is not going to be a part of the asset. You're going to expense it as incurred in the same period. Otherwise, it's going to be a major overall change, an engine being taken out and a new one put in. That's extended life of that asset. That has to be capitalized. If you're going to add more capacity for a truck, if you're going to add a roof onto your building, That's going to be extending the life, and again has to be capitalized. So how do we account for it? Now, we need to first of all remember, when we're talking about fixed assets are depreciated. How long they're depreciated really depends on the asset, but again, depreciation applies only to tangible assets. So another term that you'll need to know: what is the book value? The book value is the cost of that asset, and remember we talked about what determines what the cost is, minus the accumulated depreciation. That is the book value of that asset, which will be shown on your balance sheet. Depreciation is going to be allocating that cost, however long it is, over the useful life of that asset. 5 years, 3 years, depending on what the asset is. And what depreciation does, it allocates that expense, that incurrence of expense, depreciation, against the revenue it helps during each period. So we're systematically matching the expense with the appropriate revenue that asset generates in the appropriate year. Very, very classic example of the matching principle and consistent with the accrual basis of accounting. Land is not depreciated because we do not have a lifespan to attach to it. Land has a finite life. It is not. It has an infinite life. An infinite life. We can't say land's gonna last 20 years or 100 years. Lifespan on land is not determinable. So we just leave that land on our books at the amount of money that we paid, plus any cost to bring that land to its use, and leave it there. The only time land is touched is when the value has been impaired, and we'll talk about that later. So if we have a cost of an airplane, $32 million, well, we want to have a useful life of 20 years. And again, of certain assets, it's pretty easy to tell how long they'll live. I mean, they're not unusual. They're not customized. Generally speaking, you can kind of get a good idea how long this asset will last. And IRS rules can also help you. Computers will last a year. So generally, computers are going to be expensive. They don't have a long lifetime. Generally, it might be 3 years. But in the end, you can kind of get an idea. Or in this case, a truck. A truck may last you 4 to 6 years. Office furniture, maybe 15 to 20 years. A building, maybe 30 to 40 years. Generally speaking. So you do have a guideline as to how long an asset in general will last. And based on your use of that asset, you determine its useful life. And again, it's estimated useful life. It is not actual life. We don't know for a fact how long this asset will live, but we have a really good guess as to how long. So that's why we always say estimated useful life. So cost, useful life. Now the residual value, that's what's left over. When this asset is being used up, how much do you think the value would be? And again, it's estimated because we don't know for sure, but we have a good guess. So the value of that asset when it is all used up or at the end of its useful life, either way. And the method by which we will do it is 3. And they're all actually pretty simple. But we're going to go through each. Straight line method, units of production method, double declining. And which one is appropriate for your organization? All of these methods are appropriate using GAAP. Only one, I believe. No, actually, neither one of these are approved for tax purposes. But these are GAAP-approved methods of depreciating your assets. And which one the organization will use, it really depends on its use or the asset, the particular asset. Cost of a truck, chances are they might use the double declining method or they might use a straight line method. Units of production method would be for a manufacturer of some type of product that you will be producing something in such cases. Not always it's true, but again, use of the asset will in many ways determine the appropriate depreciation method. So if we have an asset that is $41,000 and we estimate that it will be $1,000 left over when the life of that asset has been expired. So the depreciable base, or in this case the depreciable cost, is $40,000. How do we compute depreciation expense using the straight line or sum of years or double declining? So let's think about that. So if we're going to use straight line, remember straight line is going to give you the same amount of depreciation every year. It's not going to change. So we're going to take our cost minus our residual value and divide it by the useful life to come up with our annual depreciation expense. Now remember, this is an annual number. So if you need to calculate 9 months of depreciation, you're going to have to take 9/12 of that number. or if you had it for half a year, you'll take 6/12 of that number. In any event, the depreciation on an annual basis is going to be exactly the same, and it does not change. And here we are with this example. Take 41,000 and subtract the 1,000 residual, divided by 5, we get $8,000 in annual depreciation each and every year of that asset, with the last year being prorated to ensure that the asset's book value does not fall below $1,000. And that's very important. When you record the depreciation for your asset, regardless of what method you use, you cannot depreciate it below its book value. And that book value, in our case, because we have a residual value, is going to be the cost minus total depreciation, and that's $1,000. So we cannot depreciate beyond the net book value, which is going to be $1,000 when that asset is fully depreciated. So here we go. And that's going to be our depreciation expense entry. It's not a big deal. The most important thing is understanding exactly what's happening. We are systematically allocating the cost of that truck over the periods of time where we're going to be using it to generate revenue. We are appropriately matching that expense to the revenue in the correct period. And this is a very good one too, because if you look at it, this one happens to net out equals very, very easily. And I like that. But it doesn't always work like that in the real world. As you can see, the cost is $41,000. And we've got a depreciation of $8,000. Well, this is the rate of depreciation. We know it's important because when we use the double declining method of depreciating an asset, we need to know what the depreciable rate is. And that's going to be 1 over the life. 1 over n, which is the life. That's going to be our depreciation rate. But nevertheless, we use a straight line. So in the end, this column C is not really particularly relevant for our straight line depreciation because we're not really focusing on the depreciation rate in this type of computation. What we concern ourselves with is the fact that $8,000 of the yearly depreciation expense has not changed. Every year it's going to be the same. And in some cases, depending on the life and depending on the asset value, you may not have a full $8,000 in the last year. But we want to make certain at the end of the day that the book value of that asset does not get depreciated until you reach that $1,000 book value, which is going to be the cost minus the accumulated depreciation, which is the $1,000. Because the $1,000 represents the residual value, which we are not allowed to depreciate beyond that or beyond that number. And that's one of the rules. Okay, so units of production is going to be a fixed amount of depreciation assigned to each unit. Again, this number is going to be calculated on how you use that life. It's going to be the depreciable base, or the cost minus the salvage, divided by its useful life in units, not in years. That's the difference. Let's do it. So if we have a unit of 100,000 that we are going to assume that we're going to be using that vehicle for, it could be 100,000 miles. Because it's a vehicle, it's a car. So we're going to say once we reach 100,000 miles for this vehicle, it's all used up. So that being the case, we're going to take our depreciable base, 41,000 minus 1,000, and we're going to divide it by the number of miles, not years this time. Then we get 40 cents per mile. And that's good because it gives us our unit of measurement. But then what do we do with the 40 cents? How do we then record depreciation expense? Well, if it tells you in this case that the first year they traveled, 15,000 miles. Oh no, 20,000 miles the first year, 30,000 the second, and 25 the third, and so forth. So that's all we need to do. Now we need to know, okay, if I go back to the previous screen, we got 40 cents per mile. So for year 1, we're going to be multiplying it, the number of units, which is 20,000 times the 40 cents. And again, with this particular transaction, we need to make certain that our transactions are consistent, meaning the unit rate does not change. It may be the number of units we measure it by may change, but the rate per unit is going to stay the same. And that's very important. The other thing that's important is we're never going to depreciate below the $1,000. Another thing that you can remember, our depreciation is going to stop once we have a book value of $1,000 because that is our residual value. Not all companies have a residual. They may say there's no residual, which means you fully depreciate the asset and the book value at the end would be 0. Cost minus accumulated depreciation equals 0, but not in this particular example. So, and again, double declining, again, it's all about the straight line rate. How do we calculate the straight line rate? In this example, it's 1 over the life. That 1 over the life gives you a rate. That rate is multiplied by 2. So let's take the straight line rate, which is 1 over the life, and multiply by 2, which gives us a double declining balance rate. So here we are, 1 over life in years times 2. 1 over 5, here we are, 1 over 5, and it's times 2. 1 over 5 gives you 0.20, which is 20%, by the way. And we take 20% by multiply by 2 for 40%. But then it's important to note that when we calculate depreciation, we're going to be calculating depreciation based on the book value. Every year, this number here stays the same, but each year we're going to be calculating depreciation at 40% on the book value, which means that every year as accumulated depreciation is recorded, that book value changes. So let's take a look at that. So our yearly expense for year 1 is $41,000 minus 4 and so forth. We're going to take that number and multiply by 0.4. Then we come up with our book value. This 26.4, and I'm going to get my calculator to make sure I'm leading you right, but this 6.4 is our new depreciation book value. So if we have $41,000 the first year that we purchase it, and we at the end of that year we calculate a 0.40, gives us $16,400 of depreciation expense. What now is our new book value? Well, we take our $41,000 and we subtract $16,400. We come up with a $24,600, our new book value. That is the number that we're going to use in our year 2 of our asset, and we're going to multiply that times 0.4 to come up with our next depreciation expense, which is $9,840. Now we have $16,400 plus $9,840. That's accumulated depreciation after 2 years. We're going to take that number and subtract it from the $41,000 to come up to our new depreciation, our new book value. So $14,760 times, 0.40 gives us our $5,904. This is giving you two things. When you look at this particular example, one, the depreciation is highly accelerated and is very, very high in the early years of the asset's life, and it gets progressively and quite dramatically lowered each and every year. Two, you're noticing that we are calculating the depreciation expense based on this double declining rate, and it's based on the book value. So that means we need to know that book value is going to be the cost minus the accumulated depreciation. Remember, not cost minus salvage, but the cost in total minus the accumulated depreciation. So every single year you're using a new book value to calculate your depreciation expense, knowing full well that the DB rate is going to remain the same. So the DB method differs from the other two. Obviously, the residual value is going to be ignored, and the final depreciation is going to be a plug. And a lot of times, the final depreciation might be a plug for a straight line. It really depends on the number of years. If you did the asset being depreciated over 13 years, and you come up with a very, very unusual number at the end, it doesn't follow consistently with straight line, you might very well have a difference of something very small. But at the end, we're going to fully depreciate minus any residual. So, and this is just recommendations on what method is best for the type of asset you purchase. And again, it's pretty standard. Assets that have an even lifespan, an even use, is going to be straight line. Assets that generally going to wear out because of use. A car is an example of that. A certain type of machineries might be an example of that. Double declining is going to be an organization may decide that I'm going to get the best out of this particular asset in the early years and not as much in the later years, and double declining is better for me. And here we are, just giving you the different depreciation for this asset, considering the three different methods. And again, straight line, it doesn't change. Units of production, again, up some years, down some years, but it's based on its use. And this one here is very, very important, because if your organization uses an asset in a certain way and it's only used in a certain way, units of production might be the best method to match your expense, your depreciation expense, to the revenue it's generating. An accelerated one is, again, top-down approach, very, very high level of depreciation in the early years. But again, at the end, we're going to make certain that we plug it, because we have to make certain that we do not depreciate it beyond its residual value. And this is just another depiction of how it looks depending on the method used, an actual graphic look. And straight line is used most by organizations because of its ease, and actually it makes sense. I mean, it actually makes sense to use straight line. But this is totally different for tax purposes. But for financial statement purposes, straight line is highly, very, very easy to use and prevalent to be used by organizations. So, planned assets are complicated because their lifespans and depreciation affects taxes. And again, I had mentioned a couple times that, straight line is not acceptable for tax purposes. They have to use a modified accelerated rate of depreciation. So you're always dealing with that book tax differences. And gains and losses also are considered when you actually sell that asset. You have to recognize a gain or loss on disposal. Very, very important information. So it does allow you a fast tax deduction if you're going to use accelerated. But again, we're talking and focusing on financial reporting. So using straight line is going to be really, really important to understand and use, and most certainly going to be part of your homework assignment. And you can tell from the example here, it is not that hard. It really isn't. The computation is not really all that difficult. But here is a look at how they do differ when you're talking about straight line versus accelerated, and how it affects the tax position of an organization. And it's something to think about. And this is going to be makers. Makers is definitely used for tax purposes, and it becomes important that each asset is classified in a specific category and the corresponding method of depreciation that the government allows you to use based on that type of asset. And again, it's all about which works well for your organization. If using straight line works, then your tax accountants are going to have to record a book tax difference when it comes to depreciation, because they're going to be different, period. Accelerated for tax purposes, and you're going to be more conservative using straight line for book purposes. So there's going to be a big difference there, as you can see in the previous example. And then again, if you purchase an asset in between years, you're going to have to prorate it to make certain that you do not take a full year of depreciation. And then again, number of months divided by 12, take that ratio and multiply by the depreciation expense to come up with that allocated piece for that period. Again, we're talking about very, very basic instructions, nothing very difficult. Now, let's talk about the theoretical concepts. In an asset, you have to record on your notes. You're going to have to record the assets that you have in place, a summary of those assets, and the methods of depreciation and the life of those assets. You have to also include in your notes whether or not those assets have residual value and the book value. You're going to have to, and also important to note how those assets are used. Again, this is very, very important note disclosure, but it's also important to say if you make a decision to change the method of estimating your depreciation, you're going to have to deal with a change of estimate, and the rules apply to that. And the change of estimate really means I change the way I'm going to be recording my depreciation from straight line to accelerated, or DDB, double declining balance. I have to record that difference going forward. I do not go back and change anything. This particular change of estimate you make going forward. You do not have to retroactively restate your financial statements. And this is important to note because it's a consideration. You don't want to restate your financial statements in the past. You're going to have to go back and redo your tax returns, and it gets to be ugly. And I think the AICPA and others realize that that's not worth it. It's not really a good thing to do. So going forward, you have to make that change, but you have to adequately describe the difference and why that difference, and the difference that occurred as a result of your change of estimate in your notes. And that's basically what we're doing here. Now, what if you have an asset that's fully depreciated and you sell it? Well, you could continue to use the asset, but you don't have the right to record any more depreciation because it's fully depreciated. Or you could remove it from your books when it's disposed of. Now, let's assume that we fully depreciated with no residual value. It has no book value. Asset on the books, and the contra account accumulated depreciation is negative, and you have a zero book value. Now, what happens when we dispose of an asset? Before we count, we have to make certain we have the asset's final book value. That means that we have to record, if necessary, the appropriate depreciation expense so that we can truly know. So, for example, if we're going to sell an asset and we at the beginning of the year, we recorded the prior year depreciation expense, but the beginning of the year we haven't recorded depreciation. We have to make sure that we true up that depreciation and get a true picture of the book value. So if I'm in a new year and I'm going to sell my asset in March, I have to make certain from January to the end of February that depreciation expense is recorded at the date of disposal. So if an asset is disposed of with no, it's fully owned, fully depreciated, here we are disposing of it. and we have to reverse the original entry. We have to remove the asset, which is a credit to machinery, and we have to remove the asset accumulated depreciation. But what if we not a fully depreciated asset and for no proceeds, meaning you got no cash on it, but it wasn't fully depreciated? We still have to remove all the accumulated depreciation on our books, and we have to remove the asset itself. That difference is going to be a gain or loss. In this case, it's going to be a loss because we have not fully depreciated, we have not fully used that asset. But let's just make it a little bit more complicated and more fun. We have to first of all look at this asset as we're going to sell it. We have to and it's not fully depreciated. We have to first true up all of the depreciation through the time we're getting ready to sell it. So we got to record the depreciation expense, which in this case is 9/12 of a month. And then we have to now record the actual sale. So first entry is truing up the depreciation expense at the time of sale. Now we have to record the book value. Now we know if we have all these months and we had the extra month in September, the first 9 months of September, we have $3,750 in depreciation expense. We're going to take that and subtract it from the original cost to come up with our real book value. If our book value is $6,250 and we sell it for $7,300, guess what? There's a possibility of a gain. So if the book value is smaller than the proceeds or the sale of that asset, we're going to deal with a gain. If the book value is higher than what we sold it for, we're going to deal with a loss. In this case, we have a gain, and here's a computation of that gain. And you might see questions asking you that, whether or not does a sale constitute a gain or a loss? And if it's a gain or a loss, what's the amount? And that's important. How do you derive it? This is the value of we received from that asset. The book value of that asset, again, it's the $6,250. Broken into the cost minus the accumulated depreciation, and the difference between the book value and the actual sale of that item is going to be your gain or loss. In this case, because the book value is lesser than the actual sale, cash received from the sale, guess what? You got a gain. And a gain is an other revenue account. Remember, a gain is revenue. It is not an operational revenue, and you will see it differently, placed differently on the financial statements. It's going to be underneath operational expenses because it is not operational revenue. Unless what this organization does is the sale of its assets, which is a wholly different type of transaction altogether. This is just an operational asset that they use in their organization, and they ultimately sold it prior to it being fully disposed of, and they sold it for cash. And they sold it, and they sold it at a gain. So this is going to be a revenue account in this case, but it's going to be other revenues. And it's very important for purposes of representation on your financial statements that it's recorded correctly. So here we are. Non-monetary changes are how do we deal with assets that we are going to get rid of and how they affected them when its cash is being received? Again, it's all about using common sense here. If you're going to remove an asset from your books and just completely remove an asset that's been fully depreciated, all you got to do is debit the accumulated depreciation and remove the cash, and you're done. Remove the asset and you're done. But then there are more complex issues, and the most important thing is how do we account for them? Taking your time, knowing that book value is going to be a very critical computation. Number two, calculating the depreciation through that period of time of sale is going to be important, and the cash received is going to be important, and disclosing of that. And again, I don't want to go into all the details because I think you can see it in your textbook. I do want to talk about natural resources and assets that are not tangible. So a natural resource is going to be something that's used up, something from the ground or something from the earth, oil, petroleum, etc. Timber. And we're going to show depletion because these are going to be used up. So here we go. We purchased an oil and it costs us $100 million. And it's going to extract an estimated 10 million ores. So we already know what we're going to be using to amortize. So if the depletion rate is $10 a barrel, and we can calculate that anyway, because all you need to do is just take the 10 million and divide it into 100 million, and you get that number. It's very, very important to see. We're not doing any new calculations. So we got 100 million, and we're going to divide it by 10 million. gives us $10. That's where the number comes from. So we got a $10 or the 10 per barrel. If 3 million are extracted and 1 million is sold, we got to record the entry. Let's do it one at a time. First, we're going to deal with the inventory. And that's going to be $10, which is that rate, multiplied by the number of barrels that was extracted. And look at the accounts that we're using here. We're recording an inventory. Why? Because this particular asset is being sold. And when you're selling your asset as a regular part of business, it's inventory to you. It's an asset and it's inventory. So that's why the asset inventory is being debited. Oil reserve is going to be most certainly kind of like a contra account, just to sit. And it will be used, obviously. But right now, we're going to deal with that. We're going to leave that alone. The next entry is we're going to record the cost of that barrel. If we sold only 1 million of them, we're going to take that same $10 per barrel depletion rate and multiply it by the 1 million. That's going to be the cost that we incurred. And again, how do we deal with that? We're going to remove it from its inventory, as if we would do it the same way, like cost of goods sold. So again, when we're talking about long-lived assets, we are definitely talking about matching those costs, and spreading it over the time we're going to use it. The same pretty much is true when you're dealing with intangible or assets that have a limited life, meaning you use it up. Natural resources, for example. Now we're going to talk about assets that have no physical form. Copyrights, patents, goodwill, leaseholds, franchises, broadcast licenses. All of those kinds of things are true assets to an organization, but they have no physical substance. So we're gonna deal with the ones with a life that has a limited life, which is going to be the finite life. Indefinite lives, we're going to check to make certain they're not impaired. And I'm talking about goodwill is an example of an indefinite life that we are not going to amortize, but we need to check to make certain that goodwill has not been impaired at all. And if it has been impaired, we have to determine, is the impairment permanent or is it temporary? If it's temporary, we do nothing. We just disclose it and we move on. If it's permanent, we write it down. And this is all in accounting, financial accounting, and it definitely gets into much more detail when we're in accounting intermediate. But for right now, for purposes of that, let's understand if the life of that asset is indefinite, or we have to make certain that we check it just to make sure that the value on the books is accurate. Patents granted, and they give you a 20-year life. So we pretty much know if a patent has been, have the right to sell its invention and use its invention in however we want to, it's an asset to them. But it's an asset that will have no real physical substance, but it's still of real value and needs to be disclosed and reported on the financial statements. And here's an example of how to record it. Again, it's all about what the amount of money was paid to acquire the patent and any other costs, legal costs or other. And then because we're going to use straight line, we're going to take $170,000 and we're going to divide it by life, because again, assets that are intangible, we're going to be generally using a straight line depreciation, generally speaking. So copyrights, again, trademarks, same thing, amortize over its useful life. If it has an indefinite life, meaning there's no way to tell you how long it's going to last, you do not amortize. You just check it for impairment and you move on. Franchise, the same thing, over its useful life. The right to sell a product or right to use something. Again, franchises generally have a lifespan. Generally. But if they don't, we know we can't amortize. We have to amortize anything that has a finite life. Goodwill is going to be the difference between the value of that organization and how much you pay for it. That goodwill, that imputed value of that house or that property or that business or whatever. The bottom line is we just record it when it's purchased, and we do not amortize. We will record an impairment only if the impairment is permanent. And again, here we are. And again, my major point I would say with dealing with goodwill is to ensure that you check it annually. That's the most important thing, and that's what you probably will see in a test or a question. We have a goodwill. Is it amortized or depreciated? And if it's not amortized or depreciated, how do we adjust the value of a goodwill? We test it for impairment. If it's permanently impaired, we write it down. Otherwise, we do not depreciate and we do not amortize. And that's a kind of a question that could very well pop up on a quiz. R&D is research and development costs. Years and years ago, when I was first learning accounting, I could tell you R&D costs in some cases was actually capitalized. Now, changes under some U.S. GAAP, we have to record it as an expense as incurred. Years ago, though, I'm just telling you, changes have occurred, and I had to relearn a lot of things when I started teaching, because a lot of things I was taught in school, GAAP changed. And you're going to find that what you learn here may very well be modified or changed. GAAP is an evolving and growing process, and I have seen many changes. And there is a process by which changes are made within GAAP, but the bottom line is, if you look back, there were hundreds of changes that affect how we record, what we record, and how we create our estimates. And definitely our presentation and our notes have most certainly have changed over the years. So it's very important that this is a very dynamic and very broad field, and it is subject to a lot of change. Not as change as much as information technology, but change nevertheless. So how do we deal with impairment of assets? We have to adjust the carrying value. And the carrying value is what the difference between the cost and the accumulated depreciation. The carrying value or the book value, same word, same meaning. If the carrying value is very much substantially less than its fair value, we're going to have to record it down. We're going to have to adjust it down. It's very important. So how do we deal with these types of things? And again, I don't want to spend a whole lot of time on conceptual knowledge, because I really want to get into the meat of the computations that are needed, so we can spend time on the conceptual in a discussion topic for your purpose. Really get to the meat and bones of how to compute, when to compute, and the terms associated with that, which is why I want this video to be very limited in this scope. However, it is important to perform impairment tests and determine the impairment loss. And again, I don't want to get into the details, because I want you to be able to think this through. This is not an occurrence that happens often, and it's a rare occurrence when you have to write down an asset because it's impaired. Most often, assets that are impaired, they either sell it or dispose of it. If for some reason you want to keep it on your books, you can follow some GAAP rules to do that. So again, when you're looking at someone's financial statements, you want to know how well they're using their assets in light of their revenues. Here's a return on assets. And assets are a big part of how revenue is generated. There is a relationship between the two, period. Particularly when you talk about companies like Target, and where their assets are the fundamental way they generate revenue. It's very easy, very clear relationship between the two. And how do we deal with profit margin in relationship to our income and sales? And how do we turn over our assets? And again, if you're talking about how you use your assets to generate revenues, it's very important to be able to see the turnover, because that will tell you how strong and how healthy your revenue is, and how well your assets are helping you generate revenue. And that's important when a company wants to be evaluated. Your revenue and your use of your assets and generating revenue is going to be a key ratio and a key indicator of health. One of the key indicators of health. So I don't want to go into FedEx, because I want to go into my learning objective, how we deal with the impact of these long-lived assets. Acquisition, sale, and depreciation. How do we acquire the assets? Where does it show on the cash flow statement? It's going to be shown in the investing section. When we sell it, same thing. It's going to be in the investing section. But depreciation, however, we're going to be talking about the operational section of the statement of cash flows. And this here, I would say, just print out this particular slide and use its memory, because it may not necessarily be as intuitive and easy to remember. And it'll be a great little cheat sheet for you to remember. Okay, I'm preparing a statement of cash flows and I got a transaction. Where does it go? And you can generally use this sheet here to give you an idea of how to use that until it all becomes very familiar and second nature. This is a very good cheat sheet. And here is a partial look at the statement of cash flows and the type of things. This one here is really the statement of cash flows, and again, it's helpful to use the statement of cash flow as a guide to help you determine where these particular long-lived assets would show up. So use this also as a guide, and it's a very good guide to help you figure out which area where that particular asset or that particular expense would be shown. And again, the statement of cash flows is only concerned about cash in, cash out. So if there's no cash in, cash out, and you're using the indirect method, you're going to have to add back, which in this case, we're using the indirect method of reporting the statement of cash flows. So that means your net income is going to show not only cash transactions that derive the net income, but the non-cash transactions that derive net income, in which case you're going to have to extract out those non-cash items to determine how much cash you actually used in operations. And we see depreciation as being one of those things. So I thank you very much for your time, and I'm hopeful this review gives you an idea of what items within your chapter you really need to focus your energy on and help your reading and completing your homework to be more efficient. Hopefully we'll talk again soon, and I thank you very much for your attention.